the first learning objective says describe treasury rates, LIBOR, SOFR, repo, and what is the meaning of a risk-free rate. Okay, so we'll get into this one, but let's just have a quick discussion about interest rates in general, right? When I'm looking to understand interest rates, first of all, let's say, why do we ask for an additional amount? See, if I have some money and this is time zero, if I want to invest it for say 1 year, what we are saying is that I am not happy with $100 if I want to invest, and after 1 year, if I still get $100, we are not going to be okay with getting $100. Now, let's say there is no inflation. Some of you might say, okay, but that is inflation. My prices are going to go up. Okay. Even if I say there is no inflation, inflation means the prices are going to be going up, the purchasing power reduces, right? That's called as inflation. Now, let's say inflation is zero. Even in this situation, I'm asking you, if I give you $100, would you be willing to invest without any return if I told you inflation is zero? Most people will not agree to that, right? Why? Because of the uncertainty of what might happen in that time period. We don't know, first of all, if this $100 is certain. Okay, even if I say it is certain, that means, even if I say it is certain, that means we will call this as default free. So if a US Treasury bond, that is a US government bond that is issued by the US Treasury, is usually considered as almost having no credit risk or default risk. That's called as a default free bond. Even for that bond, you might not be willing to accept the same $100. Why? Because that comes to your marginal propensity to consume, right? So if the question is it okay to consume now if you are given the option, or will you defer the consumption, invest it for a certain time and consume later? Again, people would like to get some kind of additional return because of the uncertainty. Things might happen, right? We don't know, life is unpredictable, we don't know what might happen. So if I'm not going to consume now for this period, there is something called as the temporal rate of substitution. Basically, we don't have to get into the economics aspect, but we might be okay if there is some excess return during this period. Okay, so that return is called as the real risk-free rate. And this tends to be usually above zero, unless in exceptional situations like recessions, where maybe we are worried about the safety and we might invest it at a different, where the central government might do, central bank might do certain things where the real risk-free rate might become very close to zero, but generally this is positive. Okay, so the real risk-free rate is not the notional interest rate. So if I go to a bank, if I go to say Bank of America or HDFC, whatever, and I give some money, I deposit it, they are giving some interest rate, right? So that is not real, that's your notional. And this can be risk-free. Maybe the HDFC bank is being, the savings are being guaranteed by the RBI to a certain amount. So until that point, at least, we can say that it is risk-free. But this is the notional risk-free rate. And technically, this notional risk-free rate is made up of your real risk-free rate plus your inflation. And this inflation is the baseline inflation expectation plus the expected volatility of inflation, both combined, right? So you are expecting some inflation, but the notional risk-free rate is going to add the expected inflation. But when I say expected, it is not certain, because the expectations can be different from realized. So there is also a inflation volatility of that. So this is still risk-free rate. You will get this amount. So let's say my real risk-free rate is 2% and my inflation expectation is 5%. This is made up of both the baseline inflation plus the expected vol. If I just do a simple arithmetic average, I will get arithmetic summation instead of the right way to do is to use the Fisher equation, some form of a geometric return. But let's just, for simplicity's sake, get an approximate value. So that's going to be 7%. This is called as your risk-free rate, general risk-free rate, what you will notionally receive, not adjusted for any inflation. If you adjust for that inflation, then you get your real risk-free rate, right? So we need to know the distinction between that, real and notional. Now, so far we have been talking about default-free bonds, that is basically your government bonds. When you have corporate bonds, you need to think about the risk of default, because corporates, however well capitalized they are, have some probability of default at certain times. You don't know what might happen in the economy, or there might be some accounting fraud, things like that. We don't know. So there's always some level of default risk when it comes to corporate bonds. So for the default risk, now the changes in the real rate and inflation is already captured by the risk-free rate, the nominal, the notional. Sorry, I was saying this is the nominal. I said notional by mistake. Okay. So the nominal risk-free rate is made up of the real risk-free rate plus inflation. Okay, now what I was saying is, if you have a default risk involved in that bond, then we are not okay with just the nominal risk-free rate. I need some compensation for that, right? So I need what is called as a credit spread to the nominal rate. So this credit spread you have to add. So my default, if there's a corporate bond with the default risk, so then my yield is going to be made up of the real risk-free rate plus the inflation plus the credit spread. And this credit spread, we will see, is based on the company's risk, but also sometimes sovereign risk is also there. That is, if I want to invest in Zimbabwe, the country itself might collapse. So there is also sovereign credit risk. Over and above, say, a developed economy like US or UK, you might have additional risk for investing in certain emerging market or frontier countries. Then on top of that, the company's risk. So together you have your credit spread. So that's your total yield on the corporate bond. So just a little bit of a understanding, the basic understanding we all should have. This is not directly related to any learning objective. I just thought we will give some color before we get into the learning objective itself. Okay, the first LOS, as I was saying, was asking us to understand the various rates, treasury rates and all that. So let's start with that. So the first one is your government borrowing rate, often called as your risk-free rate. This is your, in the US, it's called as the treasury rate. And GARP is primarily focused on the US market. The notation often tends to be tied to the US. So we are going to say treasury rate is the same as your government borrowing rate. The treasury department of that country, what is the bond that they issue, how much interest rate are you getting in those bonds? That is the treasury rate, the government borrowing rate. Usually, if it is a country and they are issuing bonds in their own currency, it is considered almost risk-free, particularly if it is a developed economy where there is a stability and there are like institutions that protect the rights of the lenders. Then you are kind of almost zero risk. You are having zero risk because first of all it is their own currency. Worst case they can print additional currency and then pay off the lenders, right? So that's always there. So the borrowings of the governments of developed countries, particularly like US and UK, is considered risk free. So this is also called as your risk free rate. So this is the lowest rate usually. Typically, this is the lowest possible rate on a notional basis. Okay? On a real basis, yes, you might have some slightly different numbers based on inflation. This is your first one, government borrowing rate or treasury rate. The learning objective also says what is the overnight interbank borrowing rate. Next one. These are all just understanding because we will use these terms later on. You need to know what is treasury rate, what is the interbank borrowing rate, repo rate, all of those. So interbank borrowing rate, so usually the central bank will set a minimum reserve that the banks have to keep, right? So this is your CRR or some kind of a capital reserve that they are asked to keep. And this depends on the risk-weighted liabilities, right? So the credit risk and liquidity risk, all of this, these are your based on your RWA, risk-weighted assets. Those are typically your the loans that you have given. What is the kind of credit risk there? Based on that, you need to have some reserves. But you might have less reserve or more reserve in cash, right? So what happens is there might be a requirement of one bank where they need some excess cash because they don't have enough liquidity, enough cash, where they might borrow from another bank. Another bank might not have excess cash than the reserve requirement, and they might lend to that bank. So this is called as a overnight lending or interbank borrowing overnight market. And this rate at which it is being lent in the US, it's called as the federal funds rate. So this is in the US also called as the Fed funds rate. So you have a particular level of cash that is required. So let's say you have one bank that's supposed to keep, say, 2 billion in cash. This is the requirement. But they have, say, 2.5 billion. And another bank that is supposed to keep 1.5 billion, and they only have 1 billion. So in terms of cash, they might have other assets, but they just don't have liquidity on that day. So then this bank is going to lend, right, at a certain rate. And this rate is the interbank borrowing rate or the Fed fund rates. Now, this is for one transaction. So you're going to do this across all the banks, and you get a weighted average of these rates, and that's called as your effective Fed funds rate. This one transaction, so you take a weighted average of these transactions. So what is the amount? 0.5 billion divided by the total lending on that night, on that day. multiplied by the rate at which this transaction happened, right? So weighted average of the rates. This is called as your effective Fed funds rate. In UK, this is called as SONIA, Sterling Overnight Index Average. This is in the US. In the UK, we call that as the SONIA or SONIA, Sterling Overnight. In EU, you have Esther. These are just for our terminologies and notations. Later, someone says the SONIA rate is this, so that you know it's a UK government, interbank borrowing rate, right? UK interbank borrowing rate. If they say the Esther is this percentage, you know it's a EU area interbank borrowing rate, right? So something like that. So that's your Esther. Esther is the EU exchange, the European Union overnight rate, and the Tokyo overnight average rate is called as the DONAR. The Tokyo overnight average rate. Okay. So those are the interbank borrowing rate. So Fed funds rate, SONIA, Esther. Next, third rate that we have to look at is the repo rates or repurchase rates. If I have a bank A and bank B, bank A, let's say, wants to borrow, and bank B is willing to lend. So generally what will happen is you get cash from B and you might give some collateral, right? So the bank A might give some collateral, and bank B will give cash. This is the general lending process, right? But the problem with this is, particularly on very short term, 1 day, overnight borrowing, the problem is, what if bank A doesn't repay next day? Then bank B is kind of stuck. It doesn't have liquidity. It has given the cash, assuming that bank A is going to repay that amount next day or whatever, very short term, but it is not getting the cash. Now, obviously, there are some ways as a lender you can force the company, bank A, to bankruptcy, right? Going through the bankruptcy process. But that's going to take easily a few months. But this is a liquidity issue in the very short term. So bank B might struggle to manage cash, manage liquidity in the short run. So to avoid that kind of a situation, what might bank B say is, I don't want collateral. You just sell me these securities. Okay. I don't want this collateral concept. You just sell this security to me and I will give you cash. Okay. And we will have a repurchase agreement that specifies that you, bank A, will buy back on this day. So you are not worried that you have sold, I need that security back. Don't worry about it. We will have a contract where bank A is going to buy back and bank B will agree, and bank B has to sell at a agreed upon price. Okay. So now the price at which they sell, let's say they are selling this at 99.99 million, the next day when they buy, they might have to pay 100 million to buy it back. Okay, so that difference of 0.01 million for that one day is kind of like the interest. Okay. So you might wonder, why do this sell and buy? Why not just pledge the securities as collateral and borrow? The reason is, as I was saying earlier, Bank B might be stuck with a very long drawn out bankruptcy process. But if it is sold and they don't honor the repurchase agreement, Bank B can just sell that whatever the assets that they have purchased. Bank B has purchased from Bank A. Bank A has sold it to Bank B. They now, instead of being a lender, they now own the assets and they can sell it. If the repurchase agreement specifies a certain time, by that time, Bank A doesn't pay that 100 million and buy back the security, Bank B has every right to sell it in the market and liquidate the position and convert it into cash, right? So there's usually a haircut. So if the value of the security says 100 million, you might only receive cash like 98. That 2 million is a haircut as a safety measure, right? So that's typically how the repo rates work, right? So this is for one particular transaction. Now these repos are typically done overnight, as I said, on a daily basis, overnight repos. These are the most common forms of repos, but you can also have slightly longer. We also have seen some monthly repos. And the index of the overnight repo rates in the United States, this is a very, very important. In fact, this is the typically new benchmark rate or market reference rate. This overnight repo average in the US is called as the SOFR, or secured overnight. It's secured because you are selling this asset and agreeing to buy it back. So if you don't honor it, the other bank is going to liquidate that position. So secured overnight financing rate, called as, this is almost the new norm for most banks. When we are looking at variable rate banks, floating rate bonds, variable rate bonds that are being issued, the benchmark nowadays, the market reference rate, typically, at least in North America, is going to be the SOFR. Previously, it used to be the LIBOR, but nowadays it is the SOFR that has replaced LIBOR as the predominant market reference rate. Secured overnight financing rate. So these are the rates charged on a secured repo agreements between banks on a overnight basis, on a one-day basis. All right, the next one is your reference rate. So reference rate is some kind of a benchmark or a reference rate. So in India, you might see oftentimes for borrowing, people might quote something called as the MCLR, the marginal cost of lending rate, or LIBOR, the London Interbank Offer Rate, or the Euribor, the European Union Interbank Offer Rate. So these are rates that are used as a benchmark or reference, as the word says. So if I say I'm going to use 3-month LIBOR plus 1% as the interest charged on this loan, I'm using this as my reference rate. So whatever is the LIBOR rate plus some kind of a spread, right? So this is your benchmark or reference rates. I mean, it can be anything. I'm using LIBOR. It can be, if you're in European Union, it can be even the SOFR that we saw, right? Anything can be a reference rate. So actually, let's see about the fallen rate, London Interbank Offer Rate. It's no longer there, but in our book it's given. London Interbank Offered rate. So this is a survey-based rate. You see the problem here already. It's not transaction-based, but the banks will give out an kind of like a data every day. What is the rate they are charging, or what is the rate they are being charged? It's a survey-based rate. So that means it is open to manipulation. The banks can actually lie. Sometimes they do, right? So we can't trust them. Like banks have an incentive to change the rates based on the position they have, right? And that's what happened. That's what happened. There was a scam. There were 16 banks located in London, global banks, that used to provide this daily data. What is the uh, interest rate applicable for unsecured borrowing, right? So they used to send this every morning before 11 o'clock. So the unsecured interest rate estimate. So it's a survey they used to give out prior to 11. And so you kind of took an average, weighted average of that 16 banks, and they were giving this for 5 currencies: GBP, British pounds, dollar, euro, Swiss franc, and yen. And they were giving it for various periods also, for overnight, a weekly rate, monthly rate, 3 months, 6 months, annual, like that. So they were doing this for 5 currencies, the commonly traded currencies, and for various maturities. The most commonly used LIBOR or the daily, 1 day, 3 month, and quarter, and annual one. Okay, so they used to give this out. Now the problem was, this was a reference rate, right? The problem was that people started, the banks, the 16 banks started to manipulate it. They changed it based on what will benefit them, because a lot of these LIBOR was used as a reference rate in their loan computation, in their deposit computation, the interest rate they have to pay. So the interest rate they have to receive and interest rate they have to pay based on the position they have. If they have if they are going to benefit from a higher interest rate, they will manipulate it higher. And if they will benefit from a lower interest rate, they will show this as a lower number. So this came into somewhere around 2020. People figured this out. So the investigation started back in, like, I think 2011 end or 12. But then by the time 2020, this fraudulent activity came into light, and this was discontinued by 2021. And a lot of the traders lost jobs. Some of them went to jail, but still a lot of people believe that this was just a kind of a slap on the wrist, right? Some banks had to be penalized more. But again, the regulators were saying this is not the fault of the bank shareholders or the ones who have deposited money, because if we do something more than this. But this is the kind of scam that we are super worried about. When banks lie, when global multinational banks lie, it's very tough to trust, right? So that's why we are now using the SOFR, which is a transaction based, right? The actual trade. So again, there are also risks with that, which we will see later on, how that could be potentially be manipulated even, right? But LIBOR was manipulated, and so this was discontinued. The last time it was used was in 2021. And then we started to use SOFR. Sometimes we are using Sonia, Esther, Tonar, all of that we saw earlier. So one distinction between SOFR and the other rates: SOFR is secure. The other rates we talked about here, Sonia, Esther, and Toner, they are unsecured rates. These are unsecured, I should have mentioned. There's also one more difference between LIBOR and the overnight rates like SOFR. The LIBOR is a estimate. So if I say this is my 1-day LIBOR, this is the rate I am going to charge for the next 1 day. Or if I say it's a 90-day LIBOR, this is for the next 90 days. So this is a forward-looking rate. This was a forward-looking rate. But on the other hand, the SOFR, for most of this, the overnight rates, you get to know them only after that period is over, right? So these are actual rates, which means these are after the transaction has happened, okay? So these are calculated based on transaction, not an estimate or forward-looking rate. All right, so the last type of rate is your credit-sensitive rate. So credit-sensitive rate is one that is dependent on the credit quality, the credit spread in the market. If you look at, let me bring one image here. So this is almost the last 90 years in the US. This is credit spread for AAA bonds. AAA is the highest quality, and BAA, which is a little bit lower, still investment grade. And this is the credit spread, right? We go back to our initial discussion. I said the yield is made up of the real rate plus inflation plus this credit spread. Now, this credit spread is inversely correlated with the market, with the economy, right? So it's inversely correlated with the output in an economy. So the shaded part here are all recessions. If you look at the shaded parts, this one is the Great Depression of 1929 to, and this is your global financial crisis, 2007-8. And you have your World Trade Center, right? The 2K crisis there. So you have the stagflation, right? So various time frames in the last century, we have had multiple recessions. Those are the shaded parts. And the white regions are all the economic expansion. So you can see that the spread, this one, the credit spread that we are talking about, is increasing whenever the economy is doing bad. That is, the GDP is negative or GDP is coming down. So it is, the rates are going up because the spread is going up, right? So you can see that the credit spread during recessions are very high. Right? This is during depression. And it comes down when economic activity is high, right? When the economy is doing good, the credit spread comes down, the rates come down, right? So we need to sometimes look at the credit sensitivity also for some of the loans, etc. We want a rate that has some sensitivity to the economy, not only the yield curve changes without credit risk. Yield curve means the rates, the government rates. If I spot, if I the spot rates, if I plot it across maturities, that's your yield curve. But to that, if I add credit risk, and then you have some rates that are credit sensitive, because whatever we have talked about mostly is almost risk free, right? The one exception is the LIBOR. The LIBOR is the rates that they were going to lend to people with some credit risk. So it's a credit sensitive reference rate. But otherwise, most of these rates that we are talking about is almost not having credit risk factored in, because these are treasury rates or secured overnight funding rate is almost zero credit risk. So the SOFR, unfortunately, is great because it is transaction based, but it doesn't really capture the credit risk. You can see the credit risk on a BAA, or even if you go further down the credit spectrum, like BBB or below that, the credit spread is going to be inversely correlated, highly inversely correlated with economic activity. And that is not being captured in some of the rates we have talked about, right? In even maybe the Tonar and the Sonia, because these are unsecured, maybe a little bit more, but still not fully factored in. So there has been some kind of a search for this. Several have been suggested for credit sensitive, but nothing has really gained significant prominence. Okay, but there are some that is being mentioned in our book. So one such is your BSBI. This is your Bloomberg short-term bank yield index. Bloomberg short-term bank yield. BSBI is a credit sensitive. Typically, this is going to be looking at less than 12 months. Okay. You can look at the actual transactions, the wholesale funding rates for the large global banks, and you can do for 12 months, 3 months, 6 months, things like that. Another rate that is popular in the US is your Ameribor. This is your American interbank offer rate, which was created by the American Financial Exchange. Just like your LIBOR, again, it has some issues here, and it is it's again the actual borrowing cost of the various regional banks throughout the US. Now, these are still nascent. It's not being used, BSBI, Ameribor, but people are trying to bring in the credit sensitivity because certain times you need the credit sensitivity to be factored in the benchmark rate, in the market reference rate. But I mean, predominantly, if you go look at any bonds that are being issued in the US, it's predominantly if it is a floating rate bond, it is tied to the SOFR still. SOFR is now the major benchmark rate. Okay. You can also have the swap rates, the derivative rates. So this is your swap rate. Okay, so that finishes our section 16.1, which is our first learning objective. Okay, so this is a very more of a understanding the terminologies. That's it. It's a very theoretical one. If you understand the concept and the terminologies, that's all we want to do. Very basic words that we might use later on. You need to know, if I say what is LIBOR, you need to know that it is it has some credit sensitivity. It is a forward-looking rate. Whereas if I say SOFR, you know it's transaction-based. It is an actual rate. It is not forward-looking, right? So those kind of understanding we need to have as we move along in our bond curriculum. The next LOS says, calculate the value of an investment using different compounding frequencies, various compounding frequencies. So this one is very similar to what you have learned in your QA, quantitative analysis, in your book 2. So it's kind of a repetition. So calculate. Finally, we come to a calculate learning objective after a long time. The value of an investment if I change my compounding frequency. So this we have talked about in your rates when we are looking at the in the quant side. So it's like this. So if I say that I am going to get 8% from a bank, I think this is the same example I used last time. I invest some money for 1 year, say $100. So I will get the principal plus 8% multiplied by 100, 8, and we will get 108 as the future value after 1 year. So that's $8. So the ending value after 1 year is 108. Okay. So my effective return is also 8% here. This is the compounding frequency is 1, that is annual compounding. Now, on the other hand, let's say another bank is saying we are giving 8%. The stated rate is 8%, but they're saying they will pay every 6 months. Okay, same thing. So you're getting 8% is what the bank is saying, but they are going to compound it. Basically, they're paying you the interest after 6 months and then the remaining interest after another 6 months. So $100 you invest. So now we have a timeline to think about. So I invest 100 here, and then I will get that 100 back, the principal here, no question, that's fine. Now the question is about the difference between the first scenario and the second scenario is about the interest part. So here in this period between the 6 months, between the investment and after 6 months, so this period, this earns 8% for that period on the $100. So this is half of that. You get 4% on your 100. So you will get $4 here. Okay. Now this $4 you're receiving now. So what happens is now you can put this money back to use. So apart from the 100, your new value, you can add this plus 4, the new value becomes 104, and then you can again invest this for another 6 months. And in this period, you are going to be applying that 8% by 2 on 104. Okay. So if you do that, so if I have 104 multiplied by 8%, I would be getting, I'll be getting 4.16. I already received that $4 here. So our ending value is going to be 108.16. And the effective return or effective rate is 8.16 divided by the initial investment, which is 8.16%, not 8%. So with every 6 months compounding, our effective rate is a little bit higher, 8.16 instead of here, which was 8%. So this is the effect of compounding. As we compound more times, my effective rate is going to be higher. And my future rate, future value of the investment is also going to be higher. So for this one, you can use the formula. There's a couple of formulas that's given in the book. I will write it, but obviously we are going to use the calculator in the examination to do this calculation. We don't have to memorize these formulas, but I'm just going to write it because the LOS says, what is the value of an investment with various compounding frequency? In the first case, the investment was 108 at time 1. And in the second scenario, this was 108.16. So it is a little bit more. How do you calculate this with a formula? I'm going to give you the formula. Just note it down. But we are going to do it in the exam with the calculator. So we will do it. We will compute it with the calculator as well. Future value is the initial investment at time 0 multiplied by 1 plus the stated rate for that period divided by the periodicity m raised to the power mt. Okay. So this is at time t. pt is the value or the price is equal to the price, initial price multiplied by, this is this can be, I think they're using notation A there. Okay. It doesn't matter. This can be A or P0, whatever you like, initial amount that we are depositing or investing. So M is the periodicity, like how many times it is getting compounded. So if there are, if the payment in this one is 6 months, every 6 months, how many 6 months are there? So my M is the number of periods in a year. For 6 months, there are 12 months in a year, divided by how many, the period after which we are getting will give you that how many times we are getting compounding, which is 2 here. Now, if the interest was, say, quarterly, my M is going to be 12 by 3, which is 4. For monthly, my M is going to be 12, right? If the compounding is weekly, what is my M? So you can do 365 by how many days in a week? right? So something like that, I think 52.14, you can round it to 52 weeks, right? So that's the number of times you're going to compound it. If you're getting weekly compounding, 52 times is your periodicity, right, for a weekly compounding. Now, let me ask you the periodicity here. If it is a 16 months once you get interest, what is your periodicity here, M, in that equation that we wrote? What's your M here? If my interest I receive every 16 months, what would you substitute as your M? Yes, very good. So again, so it is how many periods are there in a year? That is your periodicity, right? Or compounding frequency. So in this case, 12 months divided by 16, your periodicity is 0.75. So there are 0.75 16 months in a year, 12-month period. So that's how you calculate your YAM. And then it's just a substitution in that equation. Now, I'm going to prefer using the TVM, right? We know how to use the TVM really well. So I would highly recommend that you use the calculator. But this is a formula that we can use to calculate the future value as well. So let's just do this computation for that $100 invested for 1 year, compounded twice, that is interest paid 6 months, every 6 months. So we will do this. We already did this conceptually before. With the formula, it's going to be, what is the value? We know the answer is 108.16. So let's do this 100 principal multiplied by 1 plus the rate. The rate is 8%. And my periodicity here, because it's every 6 months, my M is going to be 2 multiplied by 2 into T. This is 1 year. So 1.04 squared multiplied by 100, and that comes to 108.16. So this is the formula approach. Now, once you are used to TVM, you will find TVM to be a lot quicker, and also you will make less mistakes. So you can use the TVM. So if I'm using the TVM, my N is going to be the number of periods, 2, and my I by Y for that period is half of the interest. So that is 4%. And my present value is 100. And you will get the same answer. So once you are used to the TVM, you don't have to use the formula. Just substitute in the calculator and you will get the future value. And this is what this LOS says. Calculate the future value of an investment with varying compounding frequency, right? So I'm going to give a simple question here. I know this is very foundational, basic one, but I want some answers. See if everyone understood. Let's use the formula first. Let's say we are investing 50 million. The stated rate is 10%, and this is compounded weekly. We are investing for 5 years. What is the future value? So you can use the formula, you can use TVM, both you can, it's up to you. What is the future value? So please calculate. This is your initial investment. I think in the book they are using the notation A, whatever you like to use. Rate is 10%, weekly compounded. The number of years is 5. Okay. Please calculate the future value here. Use the formula or the TVM or both. If you have, you can just double check that. What is your N that you're using? So it's 5 years. and how many compounding frequency we have that we have to multiply. I'm going to assume the compounding frequency is 52. If you use 52.14, you'll have a slightly different. I'm going to use 52. So we are getting 260 as the payment periods, 260 payment periods. You're getting some kind of a interest 260 times in that 5 years, right? Because it's a weekly compounding. So that is my N. My interest rate is 10 divided by 52. So this is my I by Y. Present value is 50 million. So you can, I'm just keeping it in millions. If you have typed it like this, that's fine. Payment is 0, and compute your FV, and I get the value, the future value. If I substitute these, I'm getting the future value as 82.396 million. So if I invest 50 million for 5 years, 10% weekly compounded, that's what we are getting. Now, you could have used the formula also, and you should get the same. So let's just double check that. My FV here is 50 million, 10% divided by 52. So that becomes 260 power. So 50 million, 0.01 divided by 52 plus 1 y power x 260 multiplied by 0.1, not 0.01. 10% is 10 by 100. 0.1, I made a mistake there. Sorry about that. 0.1 divided by 52. That plus 1 raised to the power 260. Okay. So this part becomes 1.6479 multiplied by 50 million. And this should give us the same answer. As you can see, the TVM is a lot quicker and it's more accurate, right? Generally, you don't make mistakes with TVM, but with the formula, like how I made like some errors here, because you don't have to convert the percentage into decimal, etc. in your TVM. It's a lot easier, and the calculator does the work. So if you like the formula, that's fine, but otherwise I would recommend to use the time value of money keys in your calculator. Okay. The last part of this section 16.2 is to convert one compounding period rate to another period. Again, I'm not a big fan of the formula, but if you like the formula, I will give you the formula. So converting interest rate compounded with one frequency, say M1, to interest rate compounded with a different frequency, say M2, the periodicity there, then you can just write the equation that we wrote previously, right? P0 multiplied by 1 plus R by M1, my first one, should be equal. What is the equivalent value? So P0 you can cancel out. So this equation becomes 1 plus R by M1. And that's equal to the other side as 1 plus R by M2. So we are interested, say I want to know this rate here, the effective rate here, that will be equivalent to this side rate. So to do this one, you can rewrite this equation. So you have to remove this exponent, etc. So if you want to remove this exponent here, you can take it to the power 1 by M2t on both the sides. Okay, both the sides I can take it to the power. you know this equation, right? Y to the power m to the power n is equal to y to the power m into n. So I want to look at this R2. So I want to remove this m2t. So I want to raise both the sides by 1 by m2t on both the sides. Then the equation is going to become m1 by m2 is equal to 1 plus R2 by M2. So we want R2. So if I bring R2 to one side, we can rearrange this equation. So M2 cross multiply. So it's going to be M2 multiplied by 1 plus R1 by M1 raised to the power M1 by M2. So this is the final equation. Calculate the rate with M2 periodicity if you know the rate with M1 periodicity, right? So to compute that, we are using this equation. Just note it down. I highly recommend using the calculator instead of this formula. Okay, I'll give you one simple problem here. We will just use the formula just to have an understanding, but I'm going to use the I conversion function in our calculator to convert. So if you're using the calculator, the steps will be, so they will give you say let's say they give you R1, you have to convert to the EAR, the effective annual rate, and from that EAR, you have to convert to R2. Okay, so two-step process with your I conversion. So they would have given the stated rate with R1, converted into a effective rate in your I conversion, and then convert it into the stated rate or the nominal rate using I conversion. Two-step process. So we will do first with the formulaic approach, and then we can use the calculator. The calculator will take you lesser time and will be more accurate. So let's use for illustration, I think we'll go with that 8%. We said initially 8%, 6-month interest payment, that is your periodicity is 2. Now I want to convert this to equivalent effective rate. So this is a 8%. 8% is my stated rate or nominal rate. We know the answers. The 6-month M is equal to 2. The effective rate is 8.16%. We had calculated that. So I can say that is equivalent to 8.16. This is one bank that is doing it this way, that they are stating 8% and they're saying they're paying it 6 months, every 6 months. Another bank is just saying they are paying 8%. That's the stated rate, but they are doing annual compounding. Now, obviously, Bank A's rate is greater than Bank B's rate because they are doing 6 months interest every 6 months, not every year. But if I have to convert the Bank A's rate to be equivalent to the Bank B's 8%, what is that? What is the rate that will be equivalent to 8%? If I change this rate such that it is equal to Bank B, what is that rate? So if I had to use that formula that we just wrote earlier, in this case, it's one of it is annual, so we can do in I conversion in one step. So it's a little bit simpler, but we will also look at a slightly more complex problem after this. So my R2 is what? My M2, the frequency that this bank is doing is 2 multiplied by 1 plus R1 8%. So in decimal, that will be 0.08 divided by frequency 1 time annual. M1 here is 1. I made a mistake here. This is 1 plus R2, what I am calculating. So my R2 will be, just kindly rewrite that equation. So I brought the R2 this side. That's 1 I should have first subtracted. This 1 would have been subtracted, and then I can only multiply it with M2. So I should have written -1. I missed that one. So that M2 is multiplied after. Just give me 1 second here. Let me rewrite that equation. I made a slight mistake in the derivation. So if I have to write this equation as R2, my M2 is equal to 1 plus R1 by M1. Only then I can cross multiply. So my R2 is going to be equal to M2 multiplied by 1 plus R1 by M1. Okay, just kindly ignore that first, the one I wrote. Made a small mistake in the derivation. We need to subtract 1 before we multiply it with M2. So this is the right equation. So I copied the old equation. So I must have subtracted 1 before multiplying with M2. M1 by M2, M1 is 1 by 2 here, -1. Okay, let's see. 1.08 raised to the power 0.5, basically a square root of that, -1 multiplied by 2. Wow. So this, as you can see, is pretty complex to do this calculation, right? 7.84% is equivalent. M is equal to 2 is equivalent to 8% with M is equal to 1. Both are same. Both are same. This is how you would do with the formulaic approach. Okay, as you can see, I don't recommend this one. This takes a lot of time and prone to mistakes. So instead, we usually use the I conversion. Second, go to your number 2, that is I conversion. It says nominal, effective, and compounding frequency. In our case, I'm converting to effective with a nominally stated rate of 8%, and the compounding frequency is 2. Compute my compounding frequency is 2. I need to calculate the nominal rate that two times compounding bank has to say, which means the effective rate here has to be 8%. That is what the other bank is giving. Compute the stated rate that this bank has to show. So the nominal rate I have to compute, and that will be 7.846 that we just calculated before. This is using your I conversion. I know that this bank is with one-time compounding, annual compounding is quoting 8%. So I want to give effectively 8% with 2 times compounding. Then what should I quote? What is the nominal rate I should quote? This bank with M is equal to 2 is 7.846%. So it's a lot quicker. It's just punching in 2 values and then computing the other value. So in this case, one side is having an annual compounding. So I could do it in one step. Okay. But there could be some scenarios where we first have to convert. If there's a different compounding frequency, not annual, something else, you first have to convert to annual and then do it. Right. In those scenarios, maybe the formula is a little bit better, or maybe it is quicker, but I would still like the I conversion because of the probability of making mistakes is lesser. Okay, so I just wanted to do a couple of questions, practice problems from the compounding frequency change. Based on that, what's the impact on the rate? What is the equivalent rate that we can quote? So if I have one bank quoting the interest rate as the quoted or the stated rate is 7% compounded semi-annually. Now, what would be a equivalent rate to quote if another bank is giving it on a quarterly basis? What would be an equivalent stated rate? I'm going to solve it both methods. First one is just the formula. The R1 is 7%, so 0.07 divided by M1 is 2. And then I'm going to add it to 1. Then y power x, M1 by M2 is 0.5, 2 by 4, minus 1 multiplied by M2, and M2 is 4. So the R2 based on the formula comes to, if I multiply it by 100, comes to 6.9397%. Okay, now let's do the I conversion method. So let's calculate the effective rate of Bank A. So Bank A's nominal rate, they say, is 7, and the compounding frequency is 2. Enter. Now come and compute the effective rate. The effective rate of Bank A is 7.12. Now with this, I'm going to find the stated rate of Bank B. Bank B is using a compounding frequency of 4. Enter, go, and then find the nominal or the stated rate for Bank B, and that also comes to 6.9397. So same one, whichever you prefer. If you are comfortable with I conversion, it tends to be a little bit quicker. But it's a two-step approach in your I conversion. You first need to find the effective rate and convert it into the stated rate for the periodicity that is asked in the question. Right. Move on to one simple formula related to compounding frequency, which is, if I am going to do this compounding continuously, that is, maybe every time we get some interest, we are going to reinvest it back, right? So that's kind of a continuous compounding. In the case of continuous compounding, the future value is given by this formula. FV is equal to your PV, or in the book they are using A. I'm going to use that. A multiplied by e to the power RT. This is our usual future value if it's continuously compounded. The rates are continuously compounded. So then the value in the future is given by the initial investment. We usually notate this as PV, so that's fine. They are using A here. How to calculate this? You can do this. So if I invest $10,000, what is the future value if the rate is 5%, and if we are investing for, say, 2 years, that comes to 11,000. So very simple formula. You just have to substitute in that to calculate the future value if it is continuously compounded. Now, one more thing we might have to be calculating is, if the interest rate is compounded m times, and I want to convert that interest rate to continuous compounding, how can I do it? Again, there is a formulaic approach, or you can use the I conversion, right? Both are fine. I conversion will be a two-step process. So let's look at the formulaic approach first. So to get to the conversion of a regular compounding to continuous compounding rate, right? A compounded interest rate with periodicity of m, let's convert that to a continuously compounded rate. Let's derive that formula first, and we will look at one illustration for this. So my continuously compounded rate should be equal to the interest rate that is being compounded with m periodicity. So what we are doing is, if I invest $1, I'm going to be getting 1 plus RM by the periodicity raised to the power, yeah, we know this one. So that $1 is going to become something like this. This is your usual formula. Right? So this is your FV is equal to PV into 1 plus R by M raised to the power M. So I'm not writing this $1 here because $1 will be the same, right? So this is going to be equal to, on this side, 1 into e to the power some continuously compounded rate. Let's notate it RC multiplied by T. We can keep the T as 1 also. So then your equation just becomes like this. And we are interested in calculating the e to the power RC. Now, if I want RC, I will have to take a natural log on both sides. So ln is the inverse of the e, the Euler's constant to the power e power. So those gets cancelled out. So you will have RC on the one side, and on this side, you're going to have the calculation to get to RC, the continuously compounded rate. We are just taking the, so this one, this ln 1 plus Rm raised to the power m, when you have a log, this power can be also written as a product. So I'm going to write it in that format, m into ln. And this is our continuously compounded rate. If I want to calculate the rate Rm, then what we have to do from this equation, we have to again take a e power on both the sides. And if you take e power on both the sides, you're going to have e to the power RC, right? And on this side, I already have m, so that will come on this left-hand side. So anyway, what I'm going to do is just give that equation Rm for computing that. You're going to have e to the power RC minus 1. Now, this is for m is equal to 1. If I have a different periodicity, then what we are going to do, basically the rate for that period minus 1. So e to the power RC by m is the rate for that period minus 1, and multiply it with the periodicity. Okay, this is for computing the regular rates with m periodicity from continuously compounded rate. Okay, so two formulas, one to calculate the continuously compounded rate and another to calculate the compounding with em frequency. Let's first calculate the continuously compounded rate. I'm going to use the formula, but I'm also going to be using the I conversion. Let's do both. Let's say the rate that we used in the last problem, 7% compounded semi-annually, convert to equivalent continuously compounded rate. So our formula for continuously compounded rate, RC, is equal to natural log 1 plus R. But if I have m that is different than 1, I'm going to have to do this m by m. And then we will multiply this entire thing with m. So what's the answer there? My Rm is 7%. Compounding frequency is 2 plus 1. Then we have to take a ln of that, 0.034 multiplied by 2 again. So we get the continuously compounded rate as 6.88. So what is quoted as 7% semi-annual compounding is equal to a continuously compounded rate of 6.88. Now let's try it with the I conversion function. From an examination point of view, I conversion is going to be quicker. So second I conversion, so the nominal rate they had given was 7, enter. and the compounding frequency was 2. Enter, go compute your effective rate. So we had already done that previously, and it was 7.1225. Now I have to convert this into a continuously compounded rate. The 7% semi-annual is the stated rate or nominal rate. So that becomes an effective rate, effective annual rate or effective annual yield of 7.1225. That's the first step from your I conversion. Now from this, we have to go and calculate the continuously compounded rate. Very simple. Come down here, change this frequency to a really high number, something like that. Then go back up and compute your nominal rate, and that will give you the same answer. Okay. So I want to give you one practice problem for this before we will go and do the other way, where we will convert a continuously compounded rate to a periodic rate. Before that, I'll just give one practice problem for everyone so that we know everyone's able to do this. These are easy marks, but particularly when you use the I conversion, it takes 5 seconds to do it. So practice question here. Let's say the current quoted rate is 10%. This is your stated rate. This institution is stating the interest rate as 10% paid monthly. Convert this to a continuously compounded rate. What is your M that you guys use for this one? M is, it's a monthly compounding. M is going to be 12 times in a year, 12 months in a year. So let's use our formula approach first. 10% for the year. So you're talking about 0.083% for every month. Okay. Plus 1. Then we take a ln there, natural log. Second, I did a e power x instead of ln, sorry. So with the formulaic approach, we are getting the answer as 9.95%. Will be more accurate. Let's just go to I conversion and check if this works. So the formulaic one is fine. As I said, the I conversion tends to be easier usually. So my stated rate is 10% or nominal rate. And the compounding frequency there is 12 times. Calculate the effective rate. The effective rate comes to 10.47. So this 10% stated rate, effectively, the EAR for that is 10.471. Now use that EAR and find the stated rate if it is compounded a lot of times, basically continuously compounded, compute it, and you will get the same answer. I am a big fan of I conversion, so I prefer to use it. If you like the formula approach, use it. Either way, you will get the same answer. In the book, they use the formula for computation, but we have the BA2 plus calculator. So it has I conversion, interest rate conversion feature. So I would recommend that you use it. Okay, so that's pretty much on the conversion to continuously compounded rate. Now let's do one the other way, the reverse one. So this one, I want to just give you a practice problem to do that using this formula. You can also use the I conversion. Again, I conversion, in my opinion, is quicker and better. So convert this continuously compounded rate to a periodic rate. Let's say my continuously compounded rate is 7.4%. Convert into a periodic rate with semi-annual compounding. So my RC is that. What is my periodic rate where M is equal to? We're going to be using the formula. That would be the formula to use. My Rm is e to the power RC by M minus 1 multiplied by M. So first approach is that, and second approach, use I conversion. All right, let's use the formulaic approach first, and let's calculate this one. So substitute in this equation e to the power RC 7.4%, 0.074 divided by periodicity of 2 minus 1 multiplied by 2. And what is that answer? Let's do that one. 0.074 divided by 2 multiplied, second e power x minus 1, 0.074 divided by 2, 0.037 minus 1, okay, 3.76 multiplied by 2 for the 2 periods. My RM becomes 7.5386%. This is with a compounding of 2 times, semi-annual compounding. What is a 7.4%? Becomes 7.5386. As you can see, like you can make mistakes. Even when I typed initially, I got a wrong answer, but it didn't make sense, so I redid it. But with I conversion, it tends to be a lot more intuitive, the process, right? So second I conversion, the nominal rate they are quoting is 7.4, and the compounding frequency is very high, something like this, like a very high number you have to type in for continuously compounding, and compute the effective rate. The effective rate, so the 7.4% compounded continuously is equal to 7.68% EAR, effective annual rate. Now use that effective annual rate, but now change the compounding to just 2 times, because we are converting into RM with a periodicity of 2. Go up and compute the nominal rate, and that should give us the RM here using I conversion. In the book, they use only formula, even in your practice problems, etc. But thankfully, we don't have to memorize these formulas. Right? The lesser the formulas we have to memorize, the better it is. And I conversion is an inbuilt function that will help us calculate this in a quicker way, and we don't have to memorize the formula also. These are easy pickings in the exam. You will definitely have to do this in one form or the other, either as an individual question or part of a question. You need to know how to convert one rate to another. So this is very important, very basic also. Like we will need this in your part 2, whichever, like whatever you do in finance, you will be dealing with rates, conversion from one convention to another. The next one, they're asking to understand zero rate. The learning objective there for this 16.4 is calculate the value of a bond based on coupon and yield, calculate the theoretical price of bond using spot rates, calculate Macaulay duration, modified duration, and dollar duration of a bond. So the next 3 learning objectives are all calculate. So we have to be hands-on here, do some computations, calculate the value of the bond using coupon and yield, then using spot rates, then also calculate the interest rate risk, that is the duration, Macaulay modified, and dollar duration. Very important concepts. This will be super critical for us to understand bonds, pricing, and interest rate risk. Okay. So let's first, I'm gonna kind of deviate from the book a little bit. Okay, so I'm not gonna go talk about zero rates right away. Let's first understand what a bond is, how to calculate the price, because the LOS says calculate the bond price, right? So that's what the objective is. So let's get to that first, and then we will talk about the zero rates after that. Bonds are the predominantly used fixed income security. Right? So you have other types of fixed incomes, like you might have a certificate of deposit, bankers acceptance, all of that. But typically the ones that is traded in the market, public markets, we call those as bonds. And the bonds have, again, a lot of classifications, but let's start with a plain vanilla bond. That's a regular bond. The plain vanilla type has a cash flow something like this. We initially pay some amount. That's the price of the bond that I pay. So this is a cash outflow. Let's assume some amount we are paying there. Then I get coupons on a periodic basis. It can be annual, it can be semi-annual, it can be monthly, whatever, some periodic basis. Let's say this is a 6-year bond and the coupon rate, let's say, is 5%. And then the initial face value or par value is set as $100. So what's the cash flow of this bond? What we are saying is we are going to get coupon 5% every period. There are 6 years, so every period I'm getting $5, $5, $5. And in the last period, I'm going to get the principal back plus the $5. So that's the cash flow. Now, what is the value here? What is the price that I have to pay for this bond? For this kind of a cash flow depends on the prevailing market rate, market interest rate. So this is, say, one of the companies, let's say Microsoft, has issued a bond like this. What is the price of this bond depends on the market rate, or we call this as the yield also, the yield in the market. And let's say for our purposes, the yield is 7%. So the prevailing interest rate for AAA bonds in the US is 7%. So that's what we will use. So bonds with same credit risk will have similar yield expectations. And so this bond, let's say for this bond, the yield expectation is 7%. What's the price of this bond? Now, to do this, we just have to use our time value of money. Keys, very straightforward. Bond pricing is just TVM. Right? That's TVM is the gift that keeps on giving. We just have to use the TVM keys, the third row, to calculate the price of the bond. So this is an annual bond, so I don't have to do anything with yen, just keep it as 6. I by Y is the yield, and this is an annual bond, so I don't have to mess anything with the yield. I just have to type 7%. They are asking us to calculate the price. We will calculate that. The payment we are receiving is $5. And the future value I will receive is $100, which is the par value. What's the price of this bond? And it comes to 90.46. So this price we calculated now comes to 90.46. So this is our first learning objective. Obviously, this is a very simple example, but calculating the price of the bond, you have to input the coupon, which is the payment, and the par value, which is the future value. And this is for a fixed rate bond, right? There are some bonds that are floating rate where the coupon changes based on the benchmark rate, MRR, the market reference rate. We talked about some of the MRRs yesterday, SOFR, LIBOR, SONAR, and all of those. So what we are going to be doing now is just one more practice problem. Now, I will change the numbers a bit. I'll maybe make it as a semi-annual payment for you to calculate the price of the bond. If the 10-year semi-annual bond has a coupon rate of 8% and market yield is 6%, compute price. Now, before you compute this, can you tell me one thing? Is the price going to be I didn't give you the par value, right? Compute price if par is 100. Now, tell me one thing before you calculate. What is the price? Is it going to be greater than 100? B, less than 100? C, can't say. Without calculation, you can just conceptually think about this. We have a coupon of 8% and the market yield is 6%. Will the price be above the par, or will it be below the par, or will it be same, or we can't predict it? See, in the illustration I did, we got the price as below the par value. The price of the bond was 90.46, which is less than 100. We call those kind of a bonds as a discount bond, those that trade below the face value. What I'm asking in this one, is the price going to be something like that, like a discount bond, or will it be a premium bond? Premium bond means the price is above the par value, so greater than 100. It's a conceptual question. You don't have to calculate to answer this. If you just think about the discounting process, right? What we did for the first one, we discounted the cash flow to today. I was receiving a cash flow of $5 every period, but I was discounting it with 7%. So the value came lower because whenever the coupon rate is lower than the market yield, because the market is giving me 7%, but this bond is giving me only 5% coupon. That means to adjust for the difference, I need to have some capital appreciation or capital gain. So I will pay a little bit lesser now instead of paying the full value of the bond, the par value. That was the scenario in the first scenario, the first case where we calculated. Now, in the second case, the coupon rate is higher, 8%, compared to the expected yield in the market of 6%. If that is the scenario, is the price going to be above 100 or below 100? A or B? That's correct. The answer is it is going to be above 100 premium bond, because this bond is paying more than the expected return in the market. So we will have a capital loss to adjust to bring it to the market yield of 6%. So we will initially pay more for this bond. That is, it will be a premium bond. Anyway, calculate the price of this bond, and then you will see that it is going to be above 100. But conceptually, you need to be able to understand this. So there's a semi-annual bond, which means you're getting payment twice a year. So the periodicity is 2, right? M is 2. Number of years, they said, is 10. So the number of payments is equal to M into 10 years. So there are 20 payments. So this kind of cash flow we are getting is 20. So this is 20, okay? Now, what is the coupon rate that was given? My coupon percentage was 8%. This is usually given as an annual rate, 99.999%. If there is anything different, they will state it. This is a coupon paid every time, every 6 months, like that they will say. Okay, otherwise they will just give you the annual coupon rate. So the annual coupon is 8%. That means it is $8 for annual basis. So for our semi-annual, it will become coupon divided by M, which is 8 by 2, which is $4. So my payment in my TVM is $4. We know the FV is 100. Then we just have to compute the price of the bond using the PV key. Price is the present value. What we are doing, we are discounting all these cash flows, 20 cash flows. So my N is 20. I by Y, what was given, the yield was 6%. Again, yield is annual. For our time value of money, we are giving the interest for that period. So that will be your yield by M, which is 6 by 2, which is 3%. So my I by Y is going to be 3. PV, we have to calculate present value of this cash flows. Payment, we said, is $4 and future value is 100. Compute the price of the bond is 114.87. You can see this is a premium bond. The price is greater than the par value, right? So when you have the price of the bond, okay, let's move on and just think about this pricing conceptually one more time. If my coupon rate is greater than the yield, what happens to the bond price? Is that going to be above the par or below the par? It's going to be greater than the par value. That is called as a premium bond. If the coupon rate is the same as the yield, then we get what is called as a par bond. That is, it will be the same as the face value. If the coupon rate is less than the yield, then that is called as a discount bond. The price will be below. The intuition you must have is when I'm getting paid more than the yield, I need to get only the market yield, but I'm getting paid more than that. That means I'm going to have to give up something else. What I'm giving up is that I have to pay a little bit more than what I will get at the end. So I will essentially have a capital loss that will reduce my total return and it will match the market yield. So that's the first scenario, right? In the second scenario, where the coupon rate is exactly matching the market yield, there is nothing to worry about. I will be paying the same price as the face value of the bond because I am getting the coupon and it is exactly matching the market rate. In the third scenario, if the coupon is being given is less than the market rate, then the people are not going to be willing to pay the face value because why would I buy this bond? The only reason we are going to buy this bond is if the price of the bond is lower, that way we get compensated with a capital gain, right? So those are the three scenarios in terms of the pricing. But again, this is a conceptual one. We need to actually be able to calculate the bond price. So I'm going to give uh, one more question. But before that, let me illustrate what we are doing here, right? What we are doing is simple discounting process. Discounting means we are calculating the present value of the future cash flows to today. To illustrate this, I'm going to maybe move to Excel and just maybe that's a little bit easier to understand. And then we will come back here and we will do one more problem. I didn't get enough answers last time for the bond calculation. So I want to give one more problem. But before that, let's illustrate this with some Excel. We will do here. So let's price a bond here. Okay, let's say the coupon and the par values are, the par value, let's say, is 100. Coupon is going to be 6%. Okay, so these are some inputs that we are giving. Market yield, we will give that input. Number of years, frequency of payment. Okay. So let's start with a very simple bond. Let's say this year is a 5-year bond. Frequency is 1, that is basically annual, right? And market yield, we will give some 7%. So what we will start, so this is the price we have to pay today. We have to calculate that. We'll just write 0, 1. What is my cash flow that I am getting in each of the periods? So right now I'm going to pay some price for the bond. That is what we have to calculate. That is what we have to compute. The cash flow I'm getting next year is going to be the par value multiplied by the coupon rate. It's an annual bond, so I don't have to divide it by frequency, but otherwise we will have to divide it by frequency for each of the cash flow period. So I'm getting $6, and that's kind of constant for the next 5 years. In the last year, I'm also going to get back my principal. So I also get back the par value. So I'll get 106. Okay. Now we have to find the present value of this cash flows. That is called as discounting. Right? The present value formula is your future value divided by 1 plus r raised to the power n. Now in your TVM, this is automatically done, but if you want to calculate it with formula, this is the formula we would be doing. So I'm going to calculate the present value of this cash flow. 6 is my future value I receive 1 year from now. So divided by 1 plus R. The R is your market yield, 7% raised to the power n first year. So it's 1, right? The R doesn't change. It's a yield is constant, so we can lock that also. So you can see that $6, the $6 that we are getting is actually worth only $5.61 in today's term, right? So the $6 that I'm receiving next year is worth only 5.61. And the year from that $6 is worth only 5.24, because the farther we go, and when the value of that dollar that I receive is worth less. So because we are now raising it to the power 2 in the denominator, 1 plus r to the power 2, and so on and so forth. So we can go to the fourth year and it is worth even lesser, 4.58. And the last one, 106, becomes, in today's dollar value, 75.58. And to find the price of the bond, all I have to do is to sum this values. And the price of the bond is just that. And this is a calculated field that we just now did. So what you would have done in your TVM is just doing this. Discount each of the payments and the future value to today, right? So that is how we are calculating it, but we don't have to do it individually like this, one by one. We can just use your TVM, give the coupon as the payment. All of this is constant, 6 5-period payments, and the future value of 100. Now, what you can see is that the discount factor here, the $1 if I get a year from now, that's equal to 0.934 today. That's called as the discount factor. The formula for discount factor, we will have to actually calculate this. This is one of the calculations given in our book on this section. So discount factor, instead of using any future value, you're just doing 1 by 1 plus r raised to the power en. So all you are going to do, I can do it like this. The discount factor, what is actually happening based on our bond. But I could also directly use the formula 1 by 1 plus r. Again, I'm reducing the decimal just for visibility, but it is the same. Right? So $1 I receive next year is worth 93 cents today. $1 I receive 5 years from now, it is worth 71 cents. That is called as discount factor, right? So any cash flow I get in fifth year, I can just multiply it with discount factor, right? So the cash flow in nth year, and if the discount factor in nth year is given as DFN, the PV of that cash flow in nth year is just your multiplication of your cash flow here multiplied by the discount factor for that. We will go to the whiteboard and then we will solve it, so it becomes a little bit easier. So that if they have directly given you discount factor, you can just multiply with the cash flow to get to the present value. So that's another way, instead of using TVM, if they have given you the discount factors, right? So, but you need to know what is the discount factor. Is basically the present value of $1 in the future that you receive. Now, let's say if I want to use a frequency something else, right? Instead of annual, if I want to do it as a semi-annual, and in that case, your computation is going to change. You will have 10 periods here instead of 5, and your cash flow is going to be different. Instead of 6 every period, it's going to be 3, and so on. So what will happen to the price of the bond in that scenario? So we can do that computation, right? Or if the yield becomes lesser, so 7% yield, the price is 95.9. If I change it to 6, what is going to be the price? It is going to become a par bond. That means the price is going to be 100, because now the discounting rate and the coupon rate is the same. So I won't expect a capital gain or a capital loss. So the price of the bond is the same as the par value. On the other hand, if the market rate is lower than the coupon rate, like something like that, then the bond becomes a premium bond like that. Counting the cash flows to today, using time value of money in the calculator, but the actual mechanics of this is just discounting each of the cash flows, the coupons, and the future value to today's value, summing them up, right? So that is what we are basically doing to calculate the price of a bond. You can see that as the yield goes up, if it goes to 9%, my price comes down. If it goes to, say, 15% in the market, my price comes down even lower, right? So as yield increases, price decreases, and as yield decreases, price increases. So that gives rise to a market risk called as the interest rate risk, right? Which is kind of the focus for us as FRMs. Like, we want to manage interest rate risk and credit risk for bonds. So that leads to the next topic that we will see in a bit, which is duration, how to calculate and measure interest rate risk, which is Macaulay duration and modified duration. And we are going to be seeing the process steps, how to calculate it, but also, thankfully, we have a calculator that helps us a bit to calculate it, right? So we'll move on to that, but I just want you to understand the computation of a bond using constant yield. If we should be all be able to do this. I'm going to give you one more practice problem, but you're not going to have Excel in the exam. So you're going to be using your time value of money and calculating that one. Let's say the par value is $1,000. I want to give it as an annual bond. Just, I don't want to confuse with the periodicity right now. Annual bond, 8 years. Market yield is 8%, and coupon is 5%. Compute price of bond. Simple question. You can think about the cash flows and see how we can discount them. We will be receiving $1,000 plus the coupon at the end of 8th year. In between, we are going to be getting the coupons. The coupons are 5% of the par. The coupons are, what is the price today? If yield is 8%. Okay, so first of all, even without calculating, you know that this bond is going to be a discount bond, right? Because my coupon is lower than the rate, so I need to be compensated with some capital gain. So this bond price is going to be less than 1,000, right? It's going to be a discount bond. So that's just a sanity check you can do in your exam, right? If you have, sometimes in the choices, if they give like both of the two choices, like as a premium and one as a discount, you don't even have to calculate. But I mean, this is not a hard computation. You can still do it in less than 10 seconds. So I think most of you have calculated. So shall I solve this one? Anyone still calculating? All right. So this is as easy as it gets. Straightforward question on the price of a bond, annual coupon. You don't need to do any adjustments. Just plug in the value in your TVM. My N is 8. I by Y is also 8%. PV is what we are going to be calculating. Payment is 50. That is 5% multiplied by the par value. Every year we are getting a coupon of $50, and future value is 1,000. My present value of this bond I'm getting is 827. Just double check it. Always you can go do recall and check the inputs. If that's correct, it's 8 years. I by Y is also 8. PV we computed. Payment is $50. And the final value we get is 1,000. So the price of the bond is 827.6. Now we can do this in Excel too, obviously, and you will get the same answer. In Excel, there is even a bond price function directly you can use, or you can do it like manually, like how we did it, discount it and add it up. Now I'm going to change the second part of this question. I'm going to change this inputs a little bit. If instead of this being annual, if it is semi-annual, 8-year bond, and the market yield, let's change it to 9%. Everything else is same. Compute the price of the bond. Coupon is 5% annual rate, and 1,000 is the par value. Par or face value is 1,000. Calculate the price of the bonds. Just a small change there. Okay, again, not super different, just a little bit of a change here. Task here to calculate the price of bond is just discounting, which we have done many times. So my number of period is M into number of years. This is a semi-annual bond, so M is 2, and number of years is 8, so my N is 16. My I by Y is the yield or rate divided by periodicity. The rate is 9 by 2. My yield is 4.5. My payment is the coupon value divided by periodicity. Coupon is $50, 5% into 1,000. And my future value is the par value, which is 1,000. Compute PV, which is the price of the bond. Present value of these future cash flows will give us the price of the bond. Right, so N is 60, I by Y 4.5, payment is 25, future value is $1,000. Compute the price. That comes to $775. We have to pay $775. That's why you have the negative sign to indicate the cash flow direction, the price of the bond. So this is the first learning objective here for bond. They had asked us to calculate the value of a bond based on coupon and yield. Okay. Right, so I think now we have done enough practice on this one. So let's move on to the next LOS. The next LOS says calculate the theoretical price of a bond using spot rates. So for that, we need to understand, first of all, what is spot rates or zero rate. It's also called as zero rates. You can define it in two ways. One way that you can think of it as the rate of a government bond with zero coupon. That is no coupons in between for a period. So this is like our fixed deposit rates, kind of like that, but it is a government one. So it is without any credit risk. So what we are saying is I invest something here at time 0. What is the rate that I have to use to discount a cash flow at any particular maturity? Let's say this is first year, second, third. Now, so far, what we have done is we have discounted the cash flows with the same rate. But in reality, you know that the 1-year rate is different than the 2-year rate, the 2-year rate is different than the 3-year rate, and so on. So why did we use one rate in all our discounting? Is because like it's just the kind of like a weighted average rate for that cash flow period. But probably a more scientific way, I don't know if it's, it will probably, the way we get to that yield, in fact, is through this method where what is the rate for 1 year? this cash flow that I receive in the first period, I'm going to discount it by 1 plus, let's call that as a zero rate, 1 year zero rate or spot rate. You can use Z or S. Right? So you will discount it that way. The second cash flow you get, that we can discount it with a 2-year zero rate. I'm going to notate it as Z2 to the power 2. So you get the idea, right? So we are going to be using that period's rate to discount it. So the coupons for each of the period, we will find the actual zero rates and then discount it. And you are going to sum them up and you will get the price of the bond. And these are the rates for that particular maturity only. And in an upward sloping yield curve, the zero rates will be higher progressively. And I use the term yield curve. Maybe we haven't talked about that. So a yield curve is when I plot the rates across various maturities, that plot is called as a yield curve, right? So this is on my x-axis, we have the maturities or the years, like that. So a normal yield curve tends to be upward sloping. That is, as the time increases, the rate increases. Okay. Now, if I use the government zero coupon rates, then this becomes your zero rate or your spot rate, right, for each of these periods. And this curve is called as the spot curve. If I am using the zero rates or spot rates. Okay. When we are using zero or spot rates, that rate is only applicable to the cash flow at that maturity. Okay, we can't use it for anything else. We have to discount the cash flow we receive in that period with that rate and bring it to present value. So we are going to have different rates for each of the maturity. And you can get this from the zero coupon bonds. And usually in the US, the bonds, the government bonds are issued as semi-annual bonds. So you can get this for every 6 months. And in between periods, we can do some interpolation to get the zero rate. If I want to look at 3 month, a 1 year, 4-month rate, we can kind of do an interpolation to get a rate in between. If I know Z2 and Z3, I want to get a rate in between, we can do an interpolation to get that, right? So that's how the spot curve is created. Now they are asking you to get the theoretical value of a bond using the zero rate or the spot rate, right? So let's do that computation for a simple bond. Because we are going to have to do this manually, they will not give you more than 2 or 3 years. So the situation here, let's start with a 2-year bond, very simple. And the zero rates in the market, Z1 say is 3% and Z2 say is 5%. That is, the 2-year spot rate is 5 and the 1-year spot rate is 3. The coupon percentage say is 4%. Par value is $100. Compute bond price. Okay, so let's just draw the timeline of the cash flow and we will discount each of the cash flow here. So it's a 2-year bond. So I have 2 cash flows and we need to find the value today at time 0. The cash flow at year 1 is how much? It's 4% multiplied by 100. That's the coupon that we will receive. It's $4. And the cash flow at year 2 is made up of both the coupon of $4 and the future value of 100. Now, we can't use directly the one single TVM. We can't use payment and I by Y, unfortunately, when they're asking you to use zero rate, because the rates are different. For the first cash flow, I'm going to discount it using Z1. And for the second cash flow, we have to use Z2, right? So, and then we'll have to add them up. The first cash flow is 4 by 1.03, and the second cash flow is 104 by 1.05 square. So you can use the TVM or the formula. It's up to you. At this point, like the formula and TVM are going to take the same time because we are doing it individually. So there's not much of a difference. So if you're using the formula, it is 4 by 1.03. Store it in one memory slot. The other one is 104 divided by 1.05 squared, and that is 94. So recall 1 plus recall 2. The price of the bond is 98.2. The first cash flow value in today's terms is 3.88, and the second cash flow 104 in today's terms is 94.33. You can also do this computation by calculating the discount factors. My first discount factor, DF1, DF stands for discount factor, is 1 by 1 plus Z1 raised to the power 1 first period. And my DF2 is 1 by 1 plus Z2 raised to the power 2. Let's do the DF calculations, and then we can multiply the cash flow. That's another way to do it. 1.03 inverse my discount factor here. The first scenario is 0.97. The second one is 1.05 squared. Take an inverse. My discount factor is 0.9070. Store it in another memory slot. Okay. So what you can do also is to get the price of the bond. We can use zero rates, or we can do cash flow in the first period multiplied by discount factor plus cash flow in the second period multiplied by discount factor, so on. Thankfully, we only have 2 periods here. So we just have to do the cash flows in the first period, which is $4, 4 multiplied by the discount, 4 multiplied by the discount factor 3.88, which is the same value we got. And the second cash flow 104 multiplied by DF2, and that comes to also the same value, 94. Just another way to think about it, if they have given you the DF1, DF2 directly instead of the spot rates, you can use this second approach. You can calculate discount factor from spot rates. You can also calculate spot rates from discount factor if they ask you to do that. So we will also do that computation. And if we add that, we are going to get the price of the bond as 98. So this is your second learning objective when it comes to bond pricing, using the spot rates or zero rates to calculate the price of the bond, the theoretical price of the bond. Okay, now for our practice, let's look at our situation. I'm going to again keep it as a 2-year bond because it's a little bit tedious to do beyond that. Coupon rate is 6%, Z1 is 4. That is your spot rate. The first year is 4. Second year spot rate is 6%. Coupon rate is also 6%. If the par value is 1,000 and your number of years is 2, annual compounding, annual coupon, calculate bond price. So 2-year bond, zero rate is 4 for the first year and 6% for the second year. $60 is the coupon 6% multiplied by the power of 1,000. And you just have to discount these two cash flows, 60 and 1,060, and bring it to today's value. So that's all we have to do. This time I'm going to use TVM instead of the formula to compute this one, just for a change. So my yen first year, yen is 1, the cash flow is 60. I by Y is 4 for the first year. Compute PV, that is 57.69. The second year cash flow is 1,060. And my I by Y is 6. So this comes to, the price of the bond comes to $1,001.08 or 9 cents. The first cash flow value, 60 by 1.04. So this value is 57.692. And this value is, summation of these two together gives you $1,001. Shall we move on? Okay, now I want you to just do the discount factor computation for these two spot rates. Very simple. If I told you the third year spot rate is 7%, what is the discount factor for third year? Just calculate this one. Compute discount factor. My discount factor, 3-year discount factor with a spot rate for 3 years as 7% is 0.8162. My discount factor DF3 is 1 divided by 1 plus 3. What is the present value of a cash flow that I get in the third year in today's terms? Present value, right? So that's just that formula, $1 in the future. If I get it, I discount it to today using that spot rate. What is that value? My zero rate or spot rate is given as 7%. So 1.07 y power x to the power 3. That's your denominator. Then take an inverse, and that comes to 0.81629. For that, let's just try to calculate the spot rate. If my discount factor is 0.875, calculate my 2-year spot rate. What is the equation for discount factor? My DF2 is 1 divided by 1 plus Z2 or S2 whole square. They have given this value as 0.875. They are asking us to calculate Z2 or S2. Okay, so let's do this one. So to get to Z2, first we have to take an inverse of this value, 0.875. Take an inverse. Then I have to take a square root to remove that square. Then I have to subtract 1. So my Z2 in decimal is 0.069. In percentage, that will be 6.9%. Basically, you will take an inverse so that you get 1 plus Z2 whole square on the top. Then you take a square root to remove the square. Then you subtract that 1 to get to the Z2 value. So I want to take an inverse. My 1 plus Z2 whole square will be inverse of this first step. Then to remove the square, I'm going to take a square root. And then to remove that 1, I will subtract that 1 this side. And that will become 0.069 or 6.904. You can just double check if this is correct or not. You can just use this 6.904. So 1, this one plus 1. And then you take a square of that. Then you take an inverse. You'll get your DF2. 0.875. All right. Are we guys clear with this? Anyone needs any more practice in any of the areas before we move to duration, which is the most important risk metric when it comes to interest rate? Okay. Before that, these are whatever we are seeing is kind of leading to that, right? I think there is also one more part I should explain, is the par yield. Right. So before we move on to duration, there's one more concept called as the par yield. Let's take this example. So we got the price of the bond a little bit above par, $1,001.1 or $1,001.08. Now the par yield is the coupon that would cause the value of the bond or the price of the bond to become par. So the payment is 59.41. The payment is 59.41. Okay, so the par yield, what we are saying is the coupon rate such that the price of the bond is going to be equal to the par value. What is the rate of the coupon such that we bring the price of the bond to the par value? Okay, now what you have to do, this is not a calculate LOS, but we need to understand the concept of what is par rate. In this prior example that we had given, we were given the coupon rate as 6%, and that means the coupon is $60. And then we calculated the price of the bond by using the zero rate. So we used the 4% for spot rate for 1 year and 6% as the second year, 2-year spot rate, and we computed it. So we discounted it and we got it as 1,001.088. But what the par rate is, what should be the coupon rate so that the price of the bond becomes 1,000, which is the par value. So this you can use either TVM or you can solve it algebraically, right? So what we have to solve is the price of the bond has to be the par value, and what is that payment value that gets me there? So payment by 1 plus Z1 plus payment plus the final, because it's a 2-year bond, I also get the par value or the face value at the end of the 2 years. So payment plus par divided by 1 plus Z2 whole squared. So what you have to do is to solve for this. So the 1 by 1 plus Z1, I can also write it as the discount factor for the first year. So we computed the DF1 and DF2. So I'm just going to do that calculation very quickly again, one more time. So my zero rate for the first year is 4%. So 1.04. Take a inverse. That's my DF1. So payment in the first year multiplied my first discount factor plus the second payment, I have to use this DF2, 1.06 squared, take an inverse, 0.889 payment. And the par value also I have to discount to today's value. So 889.99 is the present value of the $1,000 that we received 2 years from now. Bring payment to one side and move all the values to the other one. So I'm getting 1.85 payment as 110. And we find the payment to be 59.41, which makes sense, right? Because now what we are saying is my coupon percentage is 5.941%, right? Because previously we had a slightly higher price, premium bond. To bring it to par, the coupon has to reduce so that it becomes a par bond. When the coupon rate is higher than the prevailing market rate, you get a premium bond like what we had, and it is slightly higher, $1.10 higher. So we had to reduce the coupon from 60 to 59.4. That means my coupon rate has to be 5.941% instead of 6%. And this rate is called as the par rate. This is not a calculate LOS, but you need to know how to do this calculation. In case they ask you, it's a very simple equation that you put in and bring the payment or the coupon to one side. And that value, the coupon rate that you get from that calculation is your par rate. It's just a substitution and you're calculating the coupon value and from that the coupon rate such that the price of the bond is equal to the par value. Okay, let's use this one and calculate the par rate for this bond. So this is a 2-year coupon rate right now is 4%, and then we got the price of the bond to be a discount bond at 98.2. calculate the par rate or the coupon rate that will make the bond par bond, right? So please do that computation. So what we have to do to calculate the par yield is to find the coupon or the payment amount that brings the bond back to par. So my payment divided by 1 plus Z1 plus my payment divided by 1 plus Z2 should be equal to par. The 1 by 1 plus Z1, we can also write it as, I prefer that one because it's a coefficient of the payment. So we can write it as DF1 payment plus DF2 payment. We had already calculated DF1 and DF2, but that's fine. If you don't have the values, we can recalculate that. My zero rate first year is given as 3%. So my DF1 is 0.9708. 2-year zero rate is 5%. So 0.907 payment. The par value is 100. So subtract that from 100. So 9.29 is equal to 1.8779 payment. So my payment is equal to, which is also our par rate. If the coupon was 4.95%, the price of the bond would be $100. So we had a coupon of 4%. Instead of that, if it was 4.95%, the price of the bond would be 100. So that is called as your par yield or par rate. Okay, so that finishes till 16.6 section in your book in chapter 16.